started. Right, so on the cards this evening, we have theory. We're going to start off the session by covering the most important and basic points of Forex trading. So first of all, let's start with the most important question. What is a pip? So I'm going to give you guys the current price of euro US dollar. That's 1.05356. Euro 1.05356. Did I get that right? 1.0, yeah, that's fine. So I'd like you to take a look at this. Unfortunately, I need to clear that, undo. Let's try that again. Euro USD 1.05356. So let's take a look at this, because this is perhaps one of the most fundamental things in trading. When we trade, we always trade in currency pairs. So there are two currencies here. There's the euro and there's the US dollar. And whenever you trade, you see two currency pairs. And you also see a number. Now, what does this mean? This means that 1 euro is worth $1.05. The remainder are fractions of cents. Okay, I see that I got blocked. Guys, can you let me know in the chat if you can at least hear me? Please let me know so that I can continue with the workshop. Perfect. So is it just a question of my video being stuck? Okay, that's great. Can you see my whiteboard? Okay, that's good. Okay, so let's continue. So as I was saying, 1 euro is worth $1.05. The rest is a fraction of cents. Now, with trading, we actually make money on fractions of cents. And I'm going to explain how we do that later on in today's workshop. Now, you'll notice that with every currency pair, except for currency pairs that include the Japanese yen, you always have 5 numbers after the decimal point. The last number is known as the pipette, and when it comes to trading, we're not that interested in the pipette. So when we make our calculations today and tomorrow, and of course on Thursday, we will ignore the pipette. So I'm going to stop sharing the whiteboard for now, because I want you instead to take a look at this website. So guys, please take note. This website, tradingview.com, is free to use. We use it as an analytical tool, okay? So we use tradingview.com for market analysis. You might want to write that down so you can fool around with it later. I do intend to give you homework. So for those of you watching this live, I'll talk to you about homework later on. For those of you watching the recording of this, again, we'll talk privately about how you can submit homework. So what TradingView does is it shows you all possible currency pairs that are tradable. It gives you even more than currency. It gives you crypto, it gives you oil, it gives you gold, silver, the whole lot. And as you can see, this is Euro USD. There is the price, the current price of Euro USD moving in real time. You'll notice, as I said, that every single currency pair has 5 numbers after the decimal point, except currency pairs traded against the Japanese yen, in which case there are only 3 numbers behind the decimal point. In order to make it easier for you to identify the pipettes, you'll notice that the last digit is smaller than the rest. And this is designed to help us as traders calculate more easily. So let's imagine that we have a trade like this. Now, TradingView helps you calculate things. So over here, I've just put in what's known as a buy position, a buy order. What does this mean? Do I, as a trader, actually buy currency? No, I don't. What I do as a trader is I predict that the euro is going to gain strength against the dollar. How does this happen? Well, currently the price of the euro against the dollar is 1.05289, okay, and moving. If the price of the euro against the dollar rises up to here, that would mean that 1 euro is now worth $1.05 and 8 to 1. That is a difference of just over 50 pips. Remember that a pip is a unit of measurement. In trading, we always talk about pips. The expression in trading is to catch pips. In fact, my trading team is called the pip catchers. We catch pips. So a pip is a unit of measurement. The tool itself actually helps you out. In this case, it's saying that my target is 50 pips. So 50 pips is the difference between the entry price, which is here in gray, 1.05318, and the top of my green box, 1.05821. So let's write that. 1.05821 is our target. Our entry is 1.05318. Now, as I said earlier, the last digit is something we ignore when it comes to trading, okay? So let's imagine that the 1 doesn't exist, and let's imagine that the 8 doesn't exist. In order to calculate the difference between our entry price and our target price, all we'd have to do is deduct 31 from 82. By the way, in case you're wondering, this is all the mathematics you'll need in trading, plus and minus. So 82 minus 31 is 51. So in this particular trade, we stand to gain 51 pips, assuming that my prediction is correct. Now, what happens if I'm wrong? What happens if the euro continues to lose value against the dollar and the price comes down? Well, whenever the price is anywhere in my pink zone, this is my risk zone. And when we trade, take this as a rule and write this down. You should never enter into a trade unless you have a stop loss. So here are some important terms for you to take note of. Entry price, which I'll refer to as EP. take profit, TP, and stop loss, SL. These are the three most important words, phrases in trading: entry price, take profit, and stop loss. So as traders, whenever we enter a trade, we're always aware of these three things: the entry price in gray, the take profit in green, and the stop loss in red. Now we can do this for buys and for sells. So when I sell, and this is perhaps something that some of you will have trouble understanding, I don't need to own something to sell it. Because remember, as a trader, we're not actually buying or selling anything. We're simply making predictions. If we're right, the broker has to pay us the difference between our entry price and our take profit. And if we're wrong, we have to pay the broker the difference between our entry price and our stop loss. So as you can see here, we have a take profit of 50 pips, more or less, and we have a stop loss of 20 pips. So if we lose, we're going to lose less than what we stand to gain. And that is a smart thing to have when you're trading, is to make your losses small and your gains big. So I hear you ask, Clive, how the hell do we make money on fractions of cents? Well, we make money on fractions of cents because of a magical thing called leverage. The only reason that we have to trade with a broker, so when you become traders, if you want to trade with real money, you'll have to deposit money, you'll have to deposit funds with a broker. I'm not going to go into the merits of how to choose a broker because we'll be here for longer than an hour. But instead, all I'll tell you about brokers is that brokers give you something called leverage. And leverage is what enables us to make money on fractions of cents. So let's imagine, hypothetically speaking, okay, the leverage that a broker provides you with, by the way, will vary depending on the broker. I've seen leverage as low as 1 to 10, and I have seen leverage as high as 1 to 500. What does this mean? For the purpose of this evening's workshop, I'm just going to keep it simple and imagine that we're trading with a leverage of 1 to 100. This means that for the purposes of trading, your broker is going to magnify your funds by 100 times. Okay? So if you had $1, for the purposes of trading, that dollar is going to be worth $100. So if you had $100, for the purposes of trading, your broker is going to imagine that you have $10,000. Now, why would brokers do this? Because brokers need to give us leverage in order for us to trade. As otherwise, it's pretty pointless for us to trade if we have no leverage. Now, leverage is a good thing and a bad thing. It's a double-edged sword because you're going to magnify your profits as well as your losses. So it's very important when trading to use correct risk management. So let's imagine that we want to enter this trade. Okay, we are looking at Euro USD. Let's imagine, for the sake of argument, that we have what shall we, well, let's make it a $500 account. Let's see how many of you have been listening and paying attention. If I have a $500 account and the broker gives me 1 to 100 leverage, how much money do I have for the purposes of trading? 50,000. Perfect. So this is $500 in my account, real money. But because my broker is giving me 100 leverage, for the purposes of trading Forex, I now have $50,000. Let's put that up there. Now, why is this important? Well, this is important because of the next crucial term that you need to understand, which is the lot size. So your lot size is going to determine the value of each pip. So if this moves from 82, because remember, we ignore the pipettes, okay? We don't care about the fifth number, the small number. It's small for a reason. We care about anything before the small number. So just to make sure you understand, if we move from 1.0582 to 1.0583, that's a difference of 1 pip. Now, how much is a pip worth? Well, that question is answered by the lot size. So you have 3 types of, actually there are 4, but the 4th one is we don't really use. So let's start with a micro lot, a mini lot, and a standard lot. Now, a micro lot is worth $1,000. A mini lot is worth 10,000, and a standard lot is worth 100,000. So whenever we enter a position using one of these lot sizes, this is the amount that we are investing in our trade. So let's go back to our example. We have a $50,000 account because our $500 account of real money has been magnified 100 times. So we have a $50,000 account. Quick question. With a $50,000 account, can I enter into a trade with 1 standard lot? Yes or no? Let's see some answers in the chat. Yes, no, no. Only 3 answers out of 31 people. More no's. In fact, the correct answer is no. So remember, your broker is telling you, hey, for the purposes of trading, you've got a $50,000 account. So if I have $50,000, I can't trade with 100,000. So my broker will prevent me from entering a trade with 1 standard lot. However, can I trade with a mini lot? And if so, how many positions can I have open? How many trades can I get into using mini lots? 5. Correct. Good. So I can enter 5 trades at 0.1 lots, or I can enter 1 trade at 0.5 lots. Now, I'm sure you'd like to understand how all of this works. Well, let's put it this way. As I said, with trading, we make money on fractions of cents. So whenever I enter a trade, 1 trade at 0.1 lots, I'm essentially telling the broker that I'm opening a position of $10,000. Let's imagine I am buying, okay, 10,000 units of euro. I'm buying 10,000 euro in this case, at this point. I'm buying it now. Once the price reaches the top of my green box, it's moved 50 pips. Now the broker has to pay me 50 pips of a value of $10,000. What does this mean? Well, let me make it even simpler for you. On average, okay, this will differ slightly depending on the currency pair in question. But as a rule, take it as I'm about to explain. Whenever we trade at 0.01 lots, 1 pip is worth about 10 cents. Whenever we trade at 1 standard lot, 1 pip is worth around $1. And whenever we trade at a standard lot, 1 pip is worth about $10. So as you can see, guys, the larger your lot size, the more valuable a pip is. So if we had to take this trade together, 50 pips, if we had to take this trade at 50 pips with a lot size of 0.01, how much money would we make in dollars? I'm waiting to see some answers in the chat just to make sure you're following. So imagine we took this trade at 0.01 lots. How much money can we make? $5 is the correct answer. So it's 50 times 0.1, that's $5. If we had to trade this trade, if we had to take this trade with a 0.1 lot, with a mini lot, we stand to make $50. 50 pips times 1 is $50. Similarly, if we had to take the exact same trade at 1 standard lot, we stand to make $500. 50 times 10. So this is why in trading, we always talk about pips. We don't really talk about money. In my trading team, for example, we have people who trade 6-figure accounts. We have people who trade 3-figure accounts, but we can both say we caught 50 pips. In that way, we eliminate any sort of discrimination. We both caught 50 pips. Now, another important thing when taking trades is risk management. So whenever you trade, it is vital to understand how much you stand to lose. Now, in this particular example, we have a stop loss of 20 pips. It's written that right there to help you. 20 pips. So remember that for the purpose of this evening's workshop, we're always going to work on the premise that we have a $500 account of real money. Now, when we trade, I'm sorry, I just got a sign that my internet connection is unstable. So I hope I'm still, I hope you can still hear me at least. So when we trade, it is vital that we prepare ourselves for the worst. Okay, and it's very important to practice correct risk management. So personally, and with my team, we have a rule to never risk more than 2% of our account per trade. 2%. Am I suggesting you should risk 2%? No, maybe you want to risk 1% or 0.5%. But the strong recommendation is never risk more than 2%. Because if you're wrong, 2% is a loss that you can recover from. 20% is not a loss that you can recover from easily if you lose it in just one trade. So how do I know that I'm only going to risk 2%? By the way, quick calculation, guys. Let's see who's good with numbers. What's 2% of $500? $10, correct. So in this particular trade, because I have a $500 account, my risk limit is $10. I don't want to lose more than $10. So how do I know that this trade will cost me $10 if I lose? Very simple. We use something called a position size calculator. So I have one prepared here. And let's do this together so you can understand. By the way, if you want to take note of this website, it's also very useful, myfxbook.com. myfxbook.com. I'm going to start us from the home page. Okay, so all I've done is gone on home page. I hover over the home button, move down to Forex calculators, and then I can find my position size calculator. And again, guys, this website is free, so feel free to use it. So our next thing now is to figure out how we're only going to risk $10 in our example. So the currency pair we're trading is Euro USD. So over here, I'm going to choose Euro USD. For the purpose of this example, I have a US dollar account of $500. Now I only want to risk 2% of my account. My stop loss in pips is right here, 20.3. As I said, the tool makes things easier for you. So 20.3 pips, 20.3 pips. And now I can calculate. Pay attention to this, guys, because this is perhaps one of the most important parts of this evening's workshop. So as you can see, I only plan on risking $10. That's 2% of $500. So the calculator is telling me that if I want to only risk $10, I should enter a trade with a position of 0.05 lots. Notice what happens if I say I want to risk 10% of my account. I'm leaving everything the same. But if I want to risk 10% of my account, that's $50. Notice now that my lot size is 5 times what it was, because I'm now risking 5 times what I originally planned to risk. So as you can see, the higher the lot size, the more money you stand to lose. And of course, the more money you stand to gain. And this is one of the biggest mistakes of people in trading. Many people get started in trading with a small amount of money, but their impatience and their obsession with making money fast is what leads them to losing everything. Because if I risk 20% instead of 2%, okay, I stand to lose more, but I stand to make more if I'm correct. But that is dangerous. That is gambling. Trading is a risky business. But if you want to be a profitable trader, you need to take things slow. With my team in particular, we have a weekly target of 10% a week. So we strive to make 10% a week. 10% a week can take you a very long way if you give it enough time. 10% a week can really change your life if you give it enough time. But you have to treat trading with respect. You can make money very quickly if you risk a lot, and you can lose everything if you risk a lot. So this is why my advice to you is take it easy, take it slow, trust the process. Trading isn't something you're going to learn overnight. You're definitely not going to become pro traders after this week's workshop. But what I aim to give you in this workshop is clear understanding. So let me go back to the 2% risk. So I know that I'm risking $10. What do I stand to gain? Well, going back to my tool here, I can see that I have a risk to reward ratio of 2.48, which means I stand to make 2.48 times what I plan on risking. So we said $10 is our risk. So if our reward is 2.48 times greater than our risk, what do we stand to gain from this particular trade? Can I have some answers in the chat? So we're risking $10, but our gain is 2.48 times that. And the correct answer is $24.80. 2.48 times $10. So you see, guys, with trading, we can see in advance what we stand to lose and what we stand to gain. Now, $24.80. Look, let's make it $25, okay? $25, just to round it up. What is $25 in the context of $500 of real money? In percentage. What percentage of $500 is $25? 0.5? What would $50 be? There we go. 0.5, 520. The correct answer is 5%. 5%. So $500. If you made $50, that's 10%. So $25 is 5%. So now you see, guys, how we can make money trading on fractions of cents. Think about it. The real entry price was $1.05 and 31 fractions of cents. The target price was $1.05 and fractions of cents. And it's the space between these fractions of cents, these 50 pips, that enable us to grow our real money account by 5%. We made $25 off fractions of cents. This is how we make money trading. This is why leverage is important. And this is why I hope that you're understanding how we do it. I hope that this answers the question of how traders make money on fractions of cents and make real money on fractions of cents. Think about it. If I had a $10,000 account, if I had a $10,000 account and I wanted to risk 2% of that, leaving everything the same, I'm now risking $200, which is 2% of 10,000. Okay, I'm trading at practically one standard lot, 1.00. Okay, and $200 is what I plan on risking. Let me make sure I'm sharing my whole screen. $200 is what I plan on risking. But remember that my risk to reward ratio is 2.48. So I stand to make almost $500 if I had a $10,000 account. And I'm sharing this with you guys because I want you to understand a very important thing. Trading is scalable. If you can turn $500 into $550 in 1 week, you could easily turn $10,000 into $11,000 in 1 week with the same amount of time and effort. And this is why I strongly recommend that if you get into trading, start off with a low amount, money you can afford to lose, and build it slowly, because today you start with 500, next week you've got 550. The week after that, you've got 605. The week after that, you've got 660, and so on and so 665, and so on and so forth. So it builds over time. This is called compounding. And I'm going to give you an example of how powerful compounding is. So let's imagine that we have a $500 account. Okay, now please, guys, I want you to take what I'm about to show you with a pinch of salt, because this calculator assumes that you always hit your 2% a day target. Okay, and the reality can be very different. So I want to grow my account by 2% a day. 2% a day, Monday to Friday, when the Forex markets are open. 2% a day is 10% a week. In terms of length of term, instead of putting 365 days, which is 1 year, I'm going to put in 261 days, which is 1 year minus the weekends, because the Forex markets are closed at the weekend. I'm going to imagine, for the purpose of the simulation, that I'm not going to take any of my earnings out. I'm going to leave the $500 there to grow over time. I'm not going to include weekends because the Forex markets are closed at the weekend, and I'm going to calculate. So again, underline, bold, exclamation marks. Please take this with a pinch of salt. This is not an income claim. I just want to show you what hitting your 2% target every single day could lead to if you had a $500 account. That is what you could turn $500 into between the 10th of May 2022 and the 10th of May 2023. And it even shows you how. Okay, so you've started with $500 and your target is to grow that by 2%, which is $10. And you now have $510. Tomorrow, you need to make 2% of $510, which is $10.20. And now you've got that. And so on and so forth. So for those of you who think, yeah, but you know, Clive, starting with a small amount, that's a lot of time and effort just to make $10. And I agree with you, it is. But day one is $10. Day 30 is a bit less than $20. Day 60 is already $32 in a day. Day 90 is almost $60 a day. Day 120 is $105 a day. So do you see, it starts adding up, your capital starts building. And that's just on 2% a day. So assuming you always hit your target of 2% a day, it really starts becoming more and more interesting as the year goes along. This is the power of compounding. Again, guys, I do not want you to see this as an income claim. It isn't. It's purely a calculation showing you what happens if you make 2% a day. So back to our workshop. So guys, now I hope you understand the important points: entry price, take profit, and stop loss. I also hope you understand your lot size. And the one crucial thing to understand is this: if you want to make sure that you're practicing correct risk management, you simply can't enter a trade unless you know what your stop loss is in pips. Because the only way we can calculate our lot size is based on our stop loss in pips. This part of the calculator tells us what lot size we're going to use. So let's go back to $500. Okay, we're leaving the risk at 2%, but look at what happens to the lot size if we change the stop loss. Let's say we have a stop loss of 10 pips. The lot size has doubled to 0.1. When the stop loss was 20 pips, 0.05. Why? Because the lower our risk, the lower our stop loss, the higher our lot size. Does that make sense? Remember that our lot size determines the value of a pip. So if we're risking 10 pips, not 20, we can afford to increase our lot size. So if we're risking 10 pips, we have a lot size of 0.1, and we're still just risking $10. And if we had a stop loss of 20 pips, we're still risking $10, but now we've halved the lot size. So as traders, this is what we do. We analyze the markets, we take a position, we plot it on Tradingview. Remember, Tradingview is free. We plot it on Tradingview. We take note of the entry price in gray, the stop loss in red, and the take profit in green. We move our mouse over the screen and we can see that that's a 20 pip stop loss. We then come to our position size calculator, choose the correct currency pair from the list, in this case, Euro USD, put in the account currency of our actual trading account. It could be Euro, it could be pound sterling, or could be dollar, okay? Put in the size of our account, in this example, $500, put in the percentage in the risk percentage, and put in the stop loss. Only once we have all of these variables can we get the lot size. Once we have the lot size, we can enter a trade. And tomorrow's workshop is going to show you really how we take trades, okay? How we input these numbers into our trading app. So first of all, before I get to the final part of the presentation, I'd like to see if you have any questions, because I don't see any in the chat, which can only mean one thing, one of two things. Either I am an awesome teacher and you've understood everything, or I'm a terrible teacher and you've understood nothing. How many of you, at the risk of hurting my own ego here, how many of you haven't understood a thing? Is there anything you'd like me to repeat, show you again, or have I been very clear? Please let me know in the chat, because as I said, I won't repeat anything of what I did here today, but instead we're going to use it practically tomorrow. So it is very important for me to know that you've understood. Okay, that's clear to me. How to calculate the pips? That's a good question. That's a good question, Madam Lovett. How to calculate the pips? So let's do a quick exercise together, guys. Get your fingers ready in the chat, because I'm going to fire away some examples. So let's move things up to here. Pay attention, guys, because I'm going to try and make things hard for you. Take a look at this example, guys. Pay attention. There's my entry price, and there's my take profit. What's higher, the entry price or the take profit? Please put EP or TP in the chat. Which number is higher, the EP or the TP? The EP is higher, correct. So if my TP is lower, am I putting in a buy order or a sell order? Sell, correct. This is what a sell order looks like, by the way. Remember that in Forex, this is the good thing about Forex trading, guys, is that we can make money even if something is crashing. We can make money if the value of the euro is crashing against the dollar like it did here. Simply by predicting it will happen, setting our risk limit, and setting our profit target. And if we're right, we make money even if the euro is crashing against the dollar. So in this example here, the entry price is higher than the take profit. So evidently we are selling. So question, and please pay attention to what I've written there. I'm trying to make it hard for you. how many pips is my take profit? Let's see. And for you, Madam Loveth, who asked the question, I want to see your answer. I see some 19s. Any other answers? No. Good. Because the correct answer is in fact 19. There is a 19 pip difference between the entry price and the take profit. But Clive, how is that 19? I see 198 and I see 006. I see 98 and 6. But what did I say? The last digit is irrelevant. The last digit is the pipette. We ignore the last digit from our calculations. And now we can clearly see 19 and 0. So the difference in price is 19 pips. So well done to Laurent and Roger for getting that correct. And that is how we calculate pips. Does that answer your question? Yes, good. So it's very important, and I understand it can be a little bit annoying, especially if you're a beginner, but as I said, TradingView actually helps you out by making the last digit smaller so that it confuses you less. Also bear in mind that using TradingView will make that calculation for you. 50.3 pip take profit, 20 pip stop loss, right there in your face. You can't miss it. Shall we try an example with a JPY pair? So let's look at the price of Euro JPY. The current price is 137.390. Let's imagine that's our entry price. And our take profit is 137.690. What's the pip difference? This should be easy. 30 pips. The difference between 69 and 39 is 30 pips. So that's it. This is the essence of counting pips. So guys, to recap, this evening we covered very important terms in trading. We covered the entry price, the take profit, and the stop loss. So when I talk to you tomorrow about make sure your TP is at this price and your stop loss is at this price, now at least you understand. You also, I hope, understand the concept of lot size, that the larger your lot size, the more valuable one pip is. And to be clear, guys, you do not need to trade at 0.01. As you saw in my earlier example, we were able to trade at 0.05, 50 cents per pip in this case. 50 cents per pip times 20 pips, $10. So this evening we covered the important points for taking a trade. We covered what a pip is in general. We covered the lot size. We covered how to calculate the lot size to make sure that you're not risking more than you should. And we covered the all-important question of leverage. Now, I have some homework for you guys, and I promise you this. Those of you that engage, those of you that show me that you're doing homework, I promise you that you will learn much faster than those of you who just listen. It's normal. Guys, I'm an ex-teacher. I know what I'm talking about when it comes to education, okay? We learn by doing. Watching is fine. Doing is better. So I have some homework for you this evening. I'm going to stop the recording, by the way, and I'm going to give you your homework.